What's going on YouTube? This is your boy the BW Trader back again with another valuable video for you. And in this video, what I'm going to be showing you is a 95% winning trading strategy for NAS100 that you can use for you to help you pass your Ftmo, your My Forex funds prop firm challenges, whether it is Ftmo, My Forex funds, the funded traders central fund, or it is funding talent if it still exists. You may use the strategy to help you pass, and you'll be trading basically NAS100. And with this strategy, you don't have to increase your risk. Your risk appetite remains 1% throughout. You do not have to increase your risk. You stick to your risk, you stick to your rules, and then you'll be able to see this 90% winning strategy. You're able to achieve 90% win rate. So the win rate in the strategy is 90%. It has been tested. This is not a strategy that I myself have come up with. Obviously, it is a strategy that has been there on the markets, but mostly people choose to trade more difficult strategies, more complex strategies, where you're going to have a lot of indicators here on the chart. You have your Bollinger Bands, your Ichimoku, your support and resistance, rectangles, and then you are not able to see proper price action. So this strategy, you're going to be based heavily on just seeing proper price action. It is 100% a price action trading strategy. And you're going to be focused or based on seeing proper reading price action, looking at the candlestick chart patterns, the impulse, using the impulse and correction nature theory of the market. And that is what you're going to be doing. Without any further ado, let us get into the video. So I'll be utilizing this tool here. It is called the bars pattern or the bars replay tool. This bars replay tool, what I'm going to be using it is, I'm going to be using it to go back to a time in the markets, because I don't want to show you the current analysis of NAS100, because there will be a separate video for that. So I'm going to be showing you that this thing has been working on the financial market for some time now. So this data that we are currently using dates all the way back to 18 January last year, 2021. Okay. So on the 4 hour, what we are seeing on NAS100 here is it is clearly in an ascending structure. It is clearly in an ascending structure. Now, this ascending structure comes after what? It comes after an impulsive move to the upside, a correction. So we are looking for the next impulse to be to the downside. That does not mean you're going to force the market to go to the downside. You're going to keep on evolving, because you're going to trade inside this structure. Excuse me. You're going to trade inside the structure for some time before you actually get the move to the downside. So every time the market moves to that, there is a lot of potential for the market to actually move down. So without any further ado, let us analyze what we are currently seeing on the inside. So on the inside, clearly we can all see that there is this little bullish flag that is being built here. Now, when you go to a deeper time frame like your 1 hour, you're going to see this clearly. The impulse is correction, so we should be looking for the next impulsive move to the upside. So what I'm going to be showing you is basically 5 trades that you could have caught if you were using this strategy. Only 5 trades, then we can call it a day. Okay. So this is our trading. Here you're looking at the price, so you are waiting for at this structure. When the market is here, you're looking for 2 things: either for the market to come here, give you the perfect touch, and then you move, or for the market to reach this point here in a correction like that, and then you move to the upside. So you're looking for ways to capitalize on the move to the upside. Now this would be your buy at risk entry here. This is your buy at risk entry point. By risk entry, we mean the buys would have not yet confirmed, but you would still take the buy nonetheless, because of this whole impulse correction theory that we are having. Okay, so let us go deeper. Now you want to play so that we can see what the market then does. So what I'm going to be showing you is the simpler setups that you would have caught. I will not show you the more in-depth ones that are a little bit complex. I'll show you the simple ones that you will caught. So let me pause that to explain something. Clearly, what you are seeing here is the market is playing out for quite some time. You're looking for buys, right? But the most important buy that you're looking for is the buy at the break of this correction, because you'll be anticipating a whole move to the upside. Also, we are approaching the downside of the ascending. So we're anticipating that the market might actually move to the upside to give us the third touch, because we've had a first touch here, although it is still loading. We've had a first touch here, a second touch here, looking for the third touch. That is our first touch here on the ascending, second touch looking for the third touch before the collapse actually can be properly anticipated. But that does not mean the market always has to give you 3 touches when it is giving you a reversal type nature. Sometimes it can give you 2 touches and then you get the reversal. So you have to be prepared for anything, because we are trading on an imperfect market. So let us see, at that juncture there, I'll be looking for a pullback. But if the pullback does not suffice, then I'll be looking for a breakout. So the market holds itself there. If it breaks out, that is our entry. Okay, it plays out, comes to the downside a little bit, and then it eventually breaks out. So once it breaks out here, that is my entry point, my stop loss below. Which point is going to be my first target? This will be the first target because of the 90-90 rule. 90% of the time, the next impulsive move after a correction has to cover 90% of the correction. So this is what it definitely has to cover. The market has to come all the way here. So that is the 90-90 rule. So this would be your first target for a 1 to 1.7. But we are entering this with an anticipation that this could go higher, because we understand that we have this. So this could be our overall target for a 1 to 3, 1 to 2.93, which could easily become a 1 to 3. So let us go on. Then I'll also be showing you the trade management as price plays out. So we have that push there to the upside. Then price is building up. At this juncture, what I like to do is, the market has already moved away, break even. Once the market creates a proper low and then it pushes above that, then I can start securing some profits. I'll use a red horizontal ray here to show my stop loss. So my stop loss is here. So now I'm in a risk-free trade. I'm no longer risking anything. Let's see what happens. The market continues to the upside slightly. It reaches our TP level. It breaks this level. So because it broke this level, my stop loss now has to go a little bit higher, because I don't want to get taken out if the market happens to come all the way down. So let's see, continue higher, continues to break that. We do not close at TP. Remember, we do not just close at TP. So at this juncture, we have secured that. It creates a low, breaks it, so continues to secure. We secure profits there. So we are now in, we are now secured, I think, about 3% at this juncture. Yes, about 3% would have been secured, 3.04, but you're still in a trade. So this 3%, the stop loss is now here. 3% will only be closed to be realized profit if the market happens to come all the way down. So we have secured this, because remember, you do not want to hold a trade for so many hours and only for you to give back majority of the profits back to the markets. So the first aim should always be secure profits and then let the runners run, because you want to minimize your losses and maximize your profits. That is why I don't just close at TP, but rather I want to see the maximum potential that we can make from this trade while risk-free and closing, or rather securing our profits. So let us continue to the upside. The market continues, and if it creates another low and goes up, then we secure. If it comes back to take us out, then it will take us out. It's better to be safe. See that it almost took us out. I don't know if it is going to be clear, but almost took us out, literally a few pips away. The market continues to the upside, so our stop loss will have to continue being where it is. Currently, we break that. We can see now that the market is becoming a little bit more corrective. So staying on this trade could be a problem, but we'll see how the market then progresses to the upside, whether it continues higher or it comes all the way down. The market is yet to decide. It is now in a correction, and we can clearly see that this correction is a correction to the upside. So at this nature, or at this juncture rather, I'd secure a little bit more. I'd secure a little bit more. This here, put it there. Let the market continue running. it is a little bit ascending, and it takes us out. Easy. So at this level, we would have secured about that much. 3.7% would have been secured. Now we go back to the 4 hour. Now you need to understand something. Let us go back to the 4 hour so that you can clearly see. So our first trade here is a winning trade. Simple 123.74. Now we need to see something. The market has clearly formed a new high. It broke this whole ascending structure. So it could mean that the ascending has now evolved itself to become an expanding, or this goes all the way back there, which then makes proper sense. It makes far much better sense that this has now become this ascending structure, this bigger ascending structure, because we can all see that whatever is happening inside here is not impulsive. It's not impulsive, but rather is a correction. So when you go back to a smaller time structure, you'd see, let me go back. When you go back to a higher time structure, rather, you'd realize that this is the impulsive move. It's a clear direction, move with clear direction to the upside. And then this has been a correction, because we go up, we come down, we go back, we go up. So we are anticipating, because this is an impulse, a correction to the upside. The overall anticipation is the move will give you an impulse to the downside, because that is the nature of flow. That is the nature of the market. That is how the market will keep on flowing. So we have had our first trade. It has been a W. And then now we are looking at what is currently happening. It seems to be an ascending structure, but you might think, or you have reason to believe it is not yet confirmed to be the ascending. This is the ascending structure that we are looking at. So let us go to the 1 hour to see if there is an entry criteria or an entry scenario that could play out. What are we looking at? We're looking at an impulsive move, an ascending. So we are looking for the move to the downside. Also, to bring even more confluence, this, let me take this out. We know it has been a winning trade. This here happens at the top. To bring even more confluence, this structure here, this whole thing happens at the top of this, our ascending structure. So the likelihood of a move to the downside, it increases our probabilities. It makes it a little bit more of a high probability trade than a low or a medium probability trade, because if this was happening just here, then the likelihood of it going down would have been a little bit, the percentages would have been a little bit more less than what is happening here. This here, the percentage of this going down is a little bit more. So let us dive deep to read what is happening there, for us to be able to understand a little bit more. Okay, so what is happening here is the market is in an ascending structure, clearly. You can pull this there. You're expecting some sells. If the market can give you a corrective move towards that, you could take some sells. But let us see what the market then gives us. Slow movements. This could evolve also. It comes back down. That's that. So that has been confirmed. It has confirmed this here trend line that we have drawn for the potential reversal type structure. We go there, we tap. Okay, so we have tapped the trend line, but is the trade ready? We were able to tap the trend line, but is our trade ready? That is, this makes it like that because it makes proper touches. So you have to, because you want to focus on mostly on what is currently happening. So that is the ascending structure that you're currently seeing. So what I would like to see is, we have already tapped that and we're coming to the downside. I'd like to see us retest that a little bit of a pullback, and then I can take myself. If that does not happen, then I would like to take it like this. Those are the scenarios that I would like to take my risk entry. If it does not do those two scenarios, then I would wait for a reduced risk entry here to the downside. Easy call. We do not have to force the reduced risk entry. So if we can get a proper pullback to the upside, then we will be taking it to the downside with us. Okay, a little bit of a pullback there. Okay, we got a breakout instead. So the market did not give me the type of entry that I was anticipating or that I want to be involved in. So instead, we get involved on this breakout. Stop loss just above the wick. First the TP, obviously, this is where the whole thing plays out from. This is where, because your first target should always be at the beginning of your corrective nature. So the market started correcting from this low. It started building a correction. So this is where the whole ascending structure comes from. 90% of the time the market has to reach this point. So that is your first take profit level. And then overall the next inflection point would be all the way here. So that is where our next if the market happens to break this, that is where our next level should be. So that is our overall target. Let us take a look at what then plays out on our second trade. We get a straight up breakout. So immediately as the market breaks out, it did not close below, as you can see. So it worked the same way this one worked. This candlestick here worked, went back, and then the second candlestick closes below. My stop loss is put at break even, because I do not want to be in a trade where the market has likelihood to take me out. So I would rather secure my investments and let the market play out with floating profits. So at that juncture, I've secured. The market continues. We broke this low here. Therefore, I can secure some profits by putting there. So I would secure some profits. Look at that. Our TP literally very, very close to being hit, but the market goes back to the upside. So I cannot say TP was hit. So that's what happens there. If we break, okay, let's see what plays out. If the market is able to break that low, okay, so clearly we are holding up here. So secure more profits. We can secure up to here, but I'd rather secure up to that. Let's see what plays out, because we want to see if our TP takes us out. So the market then quickly takes you out right here. 4.5. So you would have secured 4.5%. Of course, you could have closed here. You could have closed here to get 9%, but I would have been taken out at 4.5 because I saw that. Remember, every time when you are entering at the top, your anticipation is not just to sell up to here. Your anticipation is to sell for the overall impulsive move, because the overall structure from the 4-hour and the daily chart is the likelihood for the market to collapse all the way to the downside. So I don't really mind getting 4.5% right there. I don't really mind getting 4.5%. So then it is still a winning trade. So we got 4.5% at first here. We got a nice percentage also. So then let us get out of it. We got about 3.75, 4.5. So that makes it 7%, between 7 and 8%. So we have secured that. Let us move on to the next place. So that is 2 trades, 3 more to go that I can show you. So at this juncture, the market is not showing us anything that is clear. As you can see, it keeps on going up and down. There's nothing that is clear that is happening here. There's no reason for me to take a sell or for me to take a buy. The market collapsed. Yes, there are some strategies that will show you that will have you anticipating for the sells right here, and they would have been right. Personally, I'll just stick to the trading strategy that I'm currently showing you. So if I've already been taken out of this and whatever is happening afterwards is not clear to me, I'd rather just wait for the market to give me clear play, because it is better for you to protect your capital by not being in a trade you do not understand the reasons for, than for you to enter into a trade Sorry for the pause. We had a problem with our audio. Hopefully the pause does not affect much of our progress here that we've already made so far. Okay, so like I was saying, what is happening here is you do not understand the type of structure that is happening. There's no clear market structure that you can clearly decode and say this is this structure, this is that structure. So instead of trying to enter haphazardly, I'd rather wait for the market to show me a clear structure that I can then identify and enter on. Excuse me. Of course there will be entry opportunities for different strategies, but as long as it's not fitting my entry criteria for this strategy that I'm currently trading, then there's no use for me to force it. So let us see what then happens afterwards. You get that the market breaks out and then it pulls back inside. Will I enter this breakout? No. Why? Because the market has not shown me anything clear for me to enter. If the market had given me something like that, then I would have taken it to the downside. But because this is a bigger structure, you have to always have this at the back of your hand, at the back of your head. This is a bigger structure, and for the bigger structures, we tend to have a lot of fake outs. So the market will fake you out. So if you're quickly taking this, you're forward into the trade, then it pulls back all the way inside, takes you out, then eventually it collapses, then you get frustrated. Your psychology loses something. You lose a percentage of your psychology. So you have to always be on the safe side of the markets. You have to always be safe, keep it safe, protect your capital instead of just haphazardly jumping in. Instead of thinking of the potentials to be made, because obviously I know the potentials from there to here, because your first target will be here, they're huge, it's insane. But also remember, as much as you can make money from a trade, there's also the possibility that you can lose money from that very same trade. There is no 100% setup. There's no setup that is 100% accurate. So let's see what then happens. The market continues a little bit to the downside, pulls back to the inside. So now at this juncture, it is clear that the market is building some structure, because look at what happened. Exactly what I was saying. The market fakes you out. Why does it fake you out? Because this is a bigger structure. This is a bigger structure. You have to be able to see these things coming. There's no way a bigger structure is just going to break to the downside without anything clear or anything solid, any solid structure supporting it. So because this broke out, we can push this to the down a little bit to the back. Keep our charts as clean as possible. Let's see what currently happens. We get that there. A push to the upside. Okay. So at this juncture here, we can clearly see you have this. We are no longer looking for buys now, because why should I continue looking for buys? The market faked that out, went to the upside, so there's no reason for me to continue looking for buys. Now you could evolve this to the inside, to the outside like that, but it will only give you 2 touches. You want to cater for multiple touches, therefore multiple touches. So there you have a touch there, a touch here, a touch there. So that is multiple touches that we have catered for. So at the top there, we are anticipating potentials for us to sell now. We are waiting for the potentials for us to sell. We are no longer looking for potentials to buy, because most likely it is an ascending structure, always looking for potentials to sell from the bottom there. So let us see what then happens on the financial markets. Nasdaq continues to the upside, reaches our top here, and then starts building some structure. Currently, there is no clear structure that is being built. So at that zone here, we can then clearly see the market has an impulse. It uses this as the impulsive leg. So this is then the impulsive leg. We are building a kind of a structure there, a correction. So it could signal a reversal, or it could be a continuation. It is yet to be determined at this juncture. So let us see. The market continues a little bit higher. In that nature, that is also corrective. Okay, so we can also then go on to focus only on what is happening there. As you can see, whatever is happening there is also a corrective thing. Whatever this is happening here is also corrective, and it's an ascending structure, but it is not yet determined itself. So let us wait a little bit longer to see clearly what it is that is happening there. The market goes a little bit higher, collapses. So this move here, this wick here, is then what makes the market make sense to us. So at this juncture, because the structure is clearly visible, clearly makes sense, we can then move on to our 1 hour to identify our entries. Remember, at the top is a risk entry. If you enter at the top, it's called a risk entry. You're entering when the market has not yet confirmed the sells. But if you're entering at the breakout, here is a reduced risk entry because the sells are kind of confirmed. So what are we looking for here? We're looking for, what I would usually do is I'd put a call out here, something like that. And then inside this call out, I'll say sell at risk entry. Sell at risk entry. That is to say, at that point, I'm only looking for sells. At that point there to the top, I'm looking for potential for us to take the market to the downside. It was not yet confirmed the sells, but it is most likely for us to collapse there. What is our structure? First, second touch, third touch. We're looking for another touch there for us to collapse. Obviously, the third touch would have been the perfect touch for us to collapse, but clearly we did not collapse. We are pulling back. So what kind of what would be the override? The override would be, if I don't get this, the override is basically the sell still happens, but we do not get the perfect entry that is part of your plan. What can you do? How do you then capitalize on the override? Override can be an impulse, a correction like that, and then we get the impulse to the downside. If you can correct along here, I'll take it to the downside, or just basically take care of yourself here. Take care of yourself here. So one other thing that could happen is, instead of reaching this point, the market could just collapse from here with a double top formation. So you have to be aware of that potential scenario also. You have to be aware of that potential scenario also. So let us see what the market then does. Pulls a little back to the downside. So clearly, at this juncture, we have confirmed. Remember, the market does not always have to give you 3 touches. At this juncture, we have already confirmed that we are looking for sells, and our first sells are to be there. But if these ones are not there, we can, if this sell does not happen or we miss the entry, we are always looking for a sell here. We're keeping that in mind. We're looking for a sell right at the breakdown, at the breakout, which would be a reduced risk entry. So let me pull back this to the back a little bit. Okay, it's like that. So you will see which one plays out. We'll see which one plays out instead. So we get a little bit of a play. The market plays it to the upside. As anticipated, we are still waiting. At this time, this is the perfect time to be. This is the perfect time for you to be as patient as possible. Because if you get FOMO'd into a trade because you see it's an ascending structure, you get FOMO'd into a trade there, then you find yourself targeting small, or you're targeting that, but now your stop loss is too big. Instead of, you could have taken this one, reduce the stop loss. You see, so you have to be a little bit, unless there is a reason, unless there's a chart pattern here, we are not taking a trade. So we'll only take a trade when the chart pattern is visible here. Okay, so we get a little bit of a push to the upside as anticipated, a tap right there. That is the touch that we are looking for. Remember, that is the touch that we are currently waiting for. We're waiting for this. So now that the market has reached our zone, what type of entry are we trying to enter? Are we trying to have? I would like that arc formation, 1, 2, impulse, correction, which is the correction would be in the form of a pullback, and then I can enter that to the downside. Then I would have confirmed that the market is most likely to start showing the reversals to the downside. So that is how you then wait for your entry. You do not just, because look at how impulsive this is to the upside. This few 1, 2, 3, 4, 5 candlesticks here to the upside are impulsive. You cannot just jump into sells. You could easily get taken out. You have to confirm that the market is about to reverse. So the confirmation would be if the market slows here in momentum and then gives us a little bit of a correction, then I would take it to the downside. So that is how I would. That is intricate criteria, though. It depends on your personality, whether you are more of a risk, of an aggressive trader, or you prefer just being patient and letting everything play out. So the aggressive one would be just to enter right as the market enters. As the market touches that, you'd enter aggressively, but the more conservative way would be for the market to just let the market play out there, correct, give you a pullback, and then you can enter. So let's see what the market then gives us. We get a little bit of a play. The market pushes to the downside. At this juncture, a lot of people are getting FOMO'd into a trade because they believe it is about to go to the downside, but we stay risk managed, remain. Aha, that is the movement that we want. A pullback again to here, because you see there was slow momentum. We are moving up, but now the way we are moving up here, if you focus here, the way we are moving up here, we are no longer impulsing to this level. You see how we are no longer moving the same way we were moving here. So there is slow momentum. I can then start anticipating to take my trades to the downside. So let's see what's happening. We get that, we tap, and we slow. Right at the close of this trade, of that candlestick, I'll be looking for my sells. Stop loss above there, a few pips above. First target is this one, obviously. First target now, because it's a risk entry. First target will be this one, which is a 2.7. Officially, the beginning, like I said, 90% rule, the beginning of the correction. The beginning of the correction is your first target always. So that will be your first target. Let's see how this trade here then plays out. We get a little bit of a push to the downside, a little bit of a pullback. Aha. At this point, I'm pulling my stop loss to break even. At this point, this is the third trade. I'm pulling my stop loss to break even. At this time, I've secured my investments. I'm not risking anything because I'm not sure that the market will clearly break. Remember, you're not sure that the market will clearly break. So you want to ensure that if the market does not break, you do not lose money. Remember that. Okay, at that juncture there, you're still at that. Then it breaks. Stop loss is now here. Because it broke the downside, it also broke this. So stop loss comes here. Stop loss just comes here. If it takes us out, it will take us out. Then you will see. It has to break this. For me to now move my stop loss again, it has to break this low. Continue holding. Continue holding. It breaks the low. So my stop loss comes here now. Just about a few pips above, because you want to give the market price to breathe. You have to give it space to breathe. You want to give this space to breathe to be able to play around that zone. We'll see. It does not take us. Look at that. A few pips away from getting taken out. Continues to the downside. A few pips from taking us out. Continues to the downside. And then if it breaks this low, we are then able to move our stop loss. It breaks that. Stop loss is now moved to that. If it hits out, it breaks our 3P, we have to move stop loss again. Breaks that, stop loss comes here. Because it breaks this. We do not want it to tap and then come all the way back up with our profits. Remember that. Now you're in a risk-free trade. You have secured all the way to here. We want to see it break this low. It breaks. Secure. Up to there. Continues. Wait. I moved this along. The entry was about there. So now you are involved in a trade like this. You're inside. You're in a trade like this. Once the market broke this one, created this. Let me take it back to where I was at. Okay. So this is what we are looking at, right? Remember, to the left, there's always this structure. There's always this structure that we have to be aware of. We were first thinking that is where it is most likely to turn, right? Now that it broke it, we want to see, is the market going to fake out or is it going to build a newer structure to then evolve this? So at that juncture, let me go back to the management because you're in a trade, right? That is your stop loss there because it broke that high. It broke the low rather. It breaks the low to the downside again. Stop loss does not change because it has not made a high. It needs to make a high for me to manage properly. So let's see. It makes structure there, breaks. Let's see. build structure again. So it's building structure there. It's corrective. Gives you a clear, precise structure. So it continues that. My stop loss comes lower because I want to secure. In actuality, I should have gotten taken out there, but I got taken out nonetheless at that level there. So if I get taken out there, in actuality, I should have been taken out around this level, but for the benefit of the doubt, let's say I get taken out around there. So how much are we talking about here? You're talking about 7.12% easily caught. 7.12% easily caught. And you would have had some potential re-entries like this one. This was a potential re-entry. Could have potentially re-entered here on this opportunity to capitalize on the move to the downside. Could have potentially re-entered on this opportunity to capitalize on the move to the downside easily. So now, what is this current structure that you're getting from the market? You have been taken out. You go back to the 4 hour to kind of read the market again. So this is our third trade. You're looking for 2 more trades before we say goodbye. We say our goodbyes. Okay. So currently we see that the market has made this, so it has evolved. It has evolved to do that. This is Nasdaq, remember. It always does these things. Always. So it has taken us out there. Let me take this out. And then let us evolve into what is currently happening. Obviously. So it did that. Okay. So it tapped here. Is this the new low that is to be respected or not? So let us take a look into the structures. Now you want to see what type of correction is going to be formed here. The market goes a little bit lower. At this juncture, I do not see anything that is tradable for me personally. So I'll just be watching to see what type of structure is the market giving me. Okay, at that high, I see the market could be building some sort of a descending, but it also has potential to be building the opposite of a descending. At this juncture, I see there's a lot of potential for a descending than the opposite of a descending. There's potential for this descending in this nature. So the market has broken out of this whole ascending structure, but instead of breaking out of it with a lot of momentum to the downside, because that is what you're expecting. We're expecting that this is corrective. We're expecting the next move to be impulsive. But instead of breaking impulsively, it is a lot more corrective, and the correction looks to be ascending in terms of an ascending structure. So this could be that, easily this type structure there. Let us then continue to see, because that means this is impulse, this is overall the ascending structure, the rather descending structure for us to go to the downside, right? So let us then go on. The market comes and taps there, but at this juncture, remember, the market is not yet confirmed. Look at that. It breaks to the downside a little bit, so it evolves the structure altogether to become that. So now that it has confirmed our structure, we can start looking for entries. I do not want to, remember, I said I'm not going to be showing you the most vigorous and aggressive trades. I'm just going to be showing you the clear, precise ones. For example, this here is a trading opportunity for me. I would have taken it, but I want to show you the clear, concise ones. Let's go on. We're looking for a buy now at the breakout. Remember that. The market taps, so it evolves that to become that. With the pin, breaks out, and it goes to the upside. So because it broke out here, you would be looking for buys easily. You'd be looking for buys. So that is our next trade. Right at the breakout there, stop loss about there, first target all the way there. First target is all the way there. Why is our first target all the way there? Simple. Remember, you have to keep in mind, remember this structure here. Remember this level. Remember what I've been preaching the whole video. It's your next impulse, the next impulse after a correction has to reach 90% of the previous. So it had literally 90% is the 90 rule. It has to reach where the correction began. So most likely we are going to reach this point here. So that would be our TP, our first TP. Let's see what then happens. The market comes all the way back inside, almost took us out, goes back there, almost comes back, breaks that. And let's see, it has to break the high for me to manage. Okay, so because I was about to be taken out here, because I saw what happened, what I would do is stop loss to break even. Stop loss to break even, secure my investments. Always secure your investment. Then let's see what happens. The market plays up around a little bit around there, takes us out at break even. We did not lose anything. Takes us out at break even. And then when it takes you out at break even, you do not lose anything. It's a break even trade. Literally, the market did not take anything from you, and you did not take anything from the markets. And that for me it's a fair deal. It's a fair deal. If the market does not take anything from me, I'm fine. So now, after getting taken out, I realized that the market has broken out of this, but it is corrective. It broke out in a corrective manner. So this correction looks a little bit like we could look for sells. But am I going to just jump into sells? No. It just means I should not anticipate the buys anymore. So I'd rather wait for the market to confirm the sells. We get that. The market continues building up. I'm not entering at that juncture because it is not yet confirmed. And the market continues playing around. Okay, let's see. You see, it breaks back inside. This is why I did not take the clears. That's why I'm saying this type structures, it is best for you to trade them at inflection points. The same way you see, this is a very important inflection point because we have that. So this is happening. It has more probability. This is exactly what I was saying about this and that. More probability when it happens at a higher value area than when it just happens randomly at an area that does not have much value. It breaks, still the market fakes out and goes back in the inside, which means this whole setup here was faked out. So now we want to understand what exactly is happening. Which correction are we building? Are we evolving to become another setup, another structure, or not? So we are trying to understand the type of structure that the market is building here, because clearly it is no longer an ascending structure, but we cannot determine whether it is going to be building a structure to the upside or a structure to the downside. Is it going to be a continuation or a reversal? So with that low being formed there, once that low gets formed there, then we see that there's potential for this. There's potential for this. There's a lot of potential. That's not what I meant to use. So we see that there's a lot of potential for this structure. So if we are forming a bull flag, then the market wants to use this as the impulse, this as the correction. We are looking for the impulsive move to the upside. So because we can clearly decode that that's what the market is trying to do, then we go to the 1 hour to look for our entry level. Now I'll show you how to pinpoint even better entries for you to enter before it even breaks out. So where the market is currently at, you'd be looking for two things. You'd be looking for these simple things to happen. The entry criteria. So we've had our first, second, looking for the third touch. The third touch does not always have to happen. Remember, I have said this throughout the entire video. We are trading an imperfect market, so therefore we cannot expect everything to be perfect. If the third touch is to come, I would expect it comes with that. If we can descend, then I'll be looking for the buys. If we can get this, I'll be looking for the buys also. This is what I'm looking for the market to come here, right? That is my go-to setup. But because they can be the override would be if the market can give me a bullish flag in the inside, then I would take that to the upside. So let us see what the market then gives us. So everything is up to the markets. So let's see what the market then chooses to give us. At this juncture, the only safe entry is the breakout. Remember, the only safe entry at this point is the breakout. But there are ways where you can pinpoint an even better entry. Clearly this high and that high are starting to make sense, but we have had a little bit of a high there. So let's see where the market builds up, comes to the downside. So at that juncture, I see that the market has built that. The market has built that. We want to see if it will confirm to the downside though. If it does not confirm to the downside, then it is most likely we are not going to take the trade early. We'll rather just wait. If it can confirm around those levels, taps and goes back inside, so it has confirmed. It has confirmed that it is indeed the same structure that is. This is the mirror effect. Remember, it is a mirror effect. The market mirrors exactly what is currently happening. The bigger term, we are looking for the bull flag. Shorter term, looking for the bull flag, a continuation to the upside. So once the market breaks this very same level, I'll be looking to take the continuation to the upside. So now, instead of waiting for the market to break this one, I can just take the bias at the breakout of this. Stop loss can be as stingy as possible. First TP, obviously, go to squeeze that a little bit to understand. First TP is this one, the beginning of the correction, always. That's your first take profit level. The next take profit level all the way up there, which is the beginning of this correction, that is our inflection point. So you're looking at a potential 1 to 7 that you could find yourself involved in. So that's the trade that you're looking at. Let's see what plays out. Slowly moving towards our entry point, and do we get triggered or not? We'll see. So clearly your stop loss will be fine here if the market happens to breaks in profit. So that is our entry. And at that juncture, this is what you're looking at. You're not anticipating the market to break both this one and that one. So at that juncture, my stop loss is at break even. Stop loss is at break even, right where the market is currently at. The market will continue to the upside, and then if it does what it's currently doing, it breaks that level, secured this, secured up to here, builds a continuation structure there. You could easily have entered again here. So because it built structure, secure up to there, so you'd keep on evolving with the markets, keep on evolving with structure. So we have won three trades, drew one, I think, had a one break even, or we won two. One break even. We are currently in profit, about to win this one, because clearly this is a stop loss to break even. Look at that, the market breaks this level, stop loss here. Because the market continued even higher, stop loss, we are waiting for the market to create a low, but we keep on securing. Secure up to there. The market now gives us a play there. We want to see if it will create a low or not. This is just a random area. I just secured randomly, remember. At this juncture, I've just secured randomly. Secure up to here this time around because it created this low. So if the market is to go back and invalidate that low, I wouldn't mind getting taken out of the trade. So let us see what then happens. The market pushes a little bit higher, builds some structure there, almost takes us out, pushes a little bit higher, and it has to break this low for me to move the stop loss. It broke it, therefore the stop loss is now moved to that. We have secured enough profits. If it can continue even higher, breaks that high, so stop loss is moved to that. Let's see, it breaks that, stop loss is moved a little bit higher to that because it broke the high. Now I'm a little bit aggressive and it takes me out. I was becoming a little bit aggressive. Why was I a little bit aggressive? Because I know I've already secured enough profits. I've already secured the maximum. I've maximized this trade. Look at that. It became a 1 to 5.5. It became a 1 to 5.5. Maximum profits reached. and I do not mind. And this wouldn't be the only amount of profits that you would have secured. Remember, there are a lot of scaling in opportunities here that you could have easily taken. This is a scaling in opportunity, could have easily been a 1-to-3 reward ratio. This is another scaling in opportunity here, could have easily been a 1-to-3, 1-to-4 reward ratio also. So you could have secured some profits right about there. This is a scaling in opportunity, could have easily taken it. This is another scaling in opportunity, you could have easily taken it to the upside. But I'm only showing you the easier ones that you after watching this video, you also would be able to catch for yourself. So I'm only showing you the easier ones. You then graduate to finding the scaling and opportunities and pinpointing entries before the overall momentum kicks in, after you are able to identify the simpler structures. So I take it I've shown you four to five entries by now. We had an entry here, first one, second one, third one there. I think this was the fourth one. So we can continue looking for another entry. One last trade. Let us see. So let's go to the 4 hour. This would be one last trade because this video is already long as it is. I don't want it to be extremely long, because then you're not going to be watching it till the end of the video, because that's what tends to happen. So clearly, let me pause now so I can clearly show you something. Clearly, the market is no longer respecting this ascending structure. See, we are able to make a few some money inside this ascending structure, but clearly currently the market does not respect it anymore. So we do not have to have it here. You can always clean your charts, right? You can always clean your charts, look at what is currently happening and focus only on that. So what is currently happening is the market has a lot of momentum to the upside. We are waiting for the market to give us structure for us to enter. This would have been structure for us to scale in. We were in a trade from here to there. We were able to capitalize. I'm happy about the capitalization. So let us wait for the next opportunity. We want to see this previous high broken if we are to enter again. So the market breaks that. So we are waiting for a continuation structure. Breaks to the downside. Clearly, it is forming some structure. Clearly, we are forming some structure there. We could easily be forming an ascending. Remember how ascending structures are formed. Ascending structures are formed in this nature. The market impulse corrects, impulse corrects, impulse. Then it gets you caught into this. It's a whole move to the upside. It gets you caught to believe the market will keep on buying. But instead, it builds such a nature. It builds such a nature. I'm sorry about that odd line there. It builds such a nature. Then as it reaches that for the third touch, retest that, and then it collapses to the downside. So exactly when you're thinking break and retest, when you're thinking the market is now about to go all the way high, it collapses all the way to the downside, because that is what they want you to do. It's mass psychology. They're getting people caught on the wrong side of the market. So what is currently happening there is the market looks a little bit like it could be ascending. It looks a little bit like it could be ascending. We are at highs. We are forming new highs. So clearly, an ascending is not an odd event. An ascending structure is not an odd event, because at new highs, the market is most likely to start moving to the downside. So this level here is no longer a level of inflection. It's no longer an inflection point. Therefore, let us focus on what is currently happening here, which is that high and this one there. That low. It's not a high, it's a low instead. Let's just see what happens. Right here, I would like this to get broken though for me to find my entry point. I prefer if this one gets broken. Safety would be for this to get invalidated. Clearly to the upside, you cannot say this. So personally, what I would do is, this is what I tended to do. Connect this with that. And it makes a clear ascending structure now. Then how do you read the price action from that? It's simple. Impulsive move, correction to the upside. So you're looking for impulse to the downside. It's quite simple. Just keep everything simple. You don't have to keep on complicating stuff with indicators, Ichimoku, Bollinger Bands, moving average, and so on and so forth. Just keep it simple. Okay, that's what you're looking at currently. The market is building that. We could easily get some sales here, but look at the structure that is currently being built. It looks a lot like impulse. This correction looks a lot like the market could potentially go even higher. So you cannot take sales if there is something like that. You have to give the market space to give you a clear, proper setup. So let's see, pushes a little bit to the downside, and we get the breakout. So we'll see if this would end up. I would close the video with another winning trade. Does it close? It closes below, because it's always important to wait for the close. Remember, it's always important to wait for the 1 hour close. Then you are in a far much safer trade than when you enter with momentum, because you think, oh, it already broke, there's no way it's coming back. It can easily wick out and it becomes a fake out, and then you would have gotten taken out. So the safety is, if you're going to be taking this reduced risk entry trades, take it at the close of the breakout, the 1 hour close, then you can take it. So this is what you'll be looking for. You're looking for that minimum. So let's see what plays out. The market pulls all the way back. If it pulls back inside, we can close our profits, close our losses early. We'll see what the market then builds there. Kind of looks like it builds in a correction. Once the market breaks there, I'll be looking to reduce my risk, because I can see this potential that the market wants to build something different. Therefore, reduce the risk to that. Now I'm no longer risking 1%, I'm risking 0.5%. Now let's see. We break those lows, break even. We break those lows. Once we break this, you see, we formed a low here. We formed the low, respected the very same low. Now we just invalidated that low. So I put my stop loss to break even, secure my investments. Now I'm no longer risking anything. If the market goes all the way back up, it will take me out. I don't mind. Let's see what happens there. We need to break this low here for me to say I change my stop loss area. Let's see. Didn't break it clearly, so we have to keep on holding. And we get an invalidation. The market is preparing to push. Seems like the market wants to build a descending structure, but at this juncture you are at break even, so you'd let the market continue playing out. And it almost took us out with small pips, a few pips, before taking us out, and officially takes us out at break even. So we had 2 break even trades, 3 winning trades. So the risk to what the winning rate there is 3 out of, it's literally 3 out of 2, 3 out of 5, but in actuality the 2 you did not lose them. It was break even trade, so you did not lose anything. So that is why I say this. If you continue, because it's only 5 trades, you cannot say it's not 90% just out of 5 trades. So that's why I'm not here. I'm not about to say the strategy has a 100% winning rate, because you didn't see any loss right now. There are plenty of setups that you could have easily went wrong when you look more, because 5 trades is not enough data for you to say this is a 100% winning strategy. You have to look into a lot more setups. It takes a little bit more for you to determine the win rate of a strategy. That is why I'm saying it is a 90% win rate. There's a 90% win rate. I hope you can take this into consideration. If your strategy is not working enough for you, you can always switch to this one. Comment down below if you're interested in more strategy breakdowns. I'll show you the very same strategy working on US30, the very same strategy working on German 30, working on GBP USD, and on currencies. It works best on currencies, but you can always use it on NAS100. I prefer trading indices because, of course, better money than currencies. Therefore, thank you for watching the video. Like, comment, share, subscribe. Comment down below any YouTube Forex video ideas that you would like me to drop. Comment, hit that thumbs up button, hit the notification bell so you get notified next time when I drop. Without any further ado, thank you for watching the video up to this late. Peace. So that's peace. We are done. Peace means we are done. Boy.